Welcome everyone. In this video, let us talk about the basics of growth at a reasonable price investing, as known as Garp, practiced by famous investors like Warren Buffett of Berkshire Hathaway Incorporated, Bill Ackman of Pershing Square Capital Management, Tiger Global Management, among others. Keep on watching if you would like to know the best 10 stocks to buy under Garp strategy ranked by yours truly according to my much-owned criteria. What is growth at a reasonable price? It is an investing strategy in which you're going to combine the concept or views of growth investing and value investing to choose your individual stocks. Growth investing is choosing growth stocks which are typically small, young, and or emerging companies which earnings are expected to increase above the average rate compared to its industry sector or the broader market. That is, it may beat the growth of S&P 500. As a growth investor, your key points with evaluating stocks are their profit margins. You can also use their gross profit margins, returns in equity or return on equity, historical and future earnings growth, and share performance. Meanwhile, value investing is choosing stocks which looks to be trading for less than its intrinsic or book value. Doing value investing, you believe that the market is overreacting to the good or bad news that results in stock price movements, which do not correspond to companies' long-term fundamentals. Therefore, you see each dip an opportunity to profit by buying that stock at discounted price, then sell it at a higher value. Therefore, combining the two principles of growth and value investing, Garp strategy is looking for companies that have shown consistent earnings growth above the broader market while excluding those companies having a very high valuation, such as high price to earnings ratio, price per book, among others. That strategy or concepts of Garp investing, I had created steps or criteria to strategize our move in selecting stocks that is worthy for long-term investing. So first, I have price to earnings growth or PEG ratio of 1 or less than 1. Actually, Garp is based on PEG ratio which must be equal to 1 or less. Second, low price to earnings or PE multiples which we'll be using for exclusion or elimination stage. Next, then, low price per book and price to sales multiples. Then, we have to consider also their earnings growth, specifically 5-year growth rate, which can be found in Yahoo Finance. Also, PE multiples can also be found in Yahoo Finance. Price per book can also be found in Yahoo Finance. Also, the PEG ratio in Yahoo Finance. Strong balance sheet. Particularly, I'm looking for having a strong liquidity, current ratio, and the quick asset ratio. While solvency, I will consider or I will focus on debt to equity ratio. 6 is knowing their profitability. So first, we'll rank them up through gross margin, net income margin or profit margin, then return and equity. 7, stock performance within the year. So the movements of this stock, is it moving or is it dipping or it's increasing? Then get its intrinsic value versus current price. Of course, you have to select the stocks having an intrinsic value higher than its current price or market value. Then, consider also their economic moat and potential gain. So this is good because you have to consider how much you'll be gaining according to the analyst, right? The mean analyst target price. You have to compare it to market price and then compare also to the intrinsic value if you're going to hold the stock for more than 5 years. So guys, let us apply this criteria to the 10 companies having PEG ratio below 1. Which of these companies is the best stock to buy in 2021? So on my list, guys, I have ASO, Academy Sports and Outdoors Incorporated. Also, I have Cloudera Incorporated or CLDR, Dana Incorporated or DAN, DEN, Ford Motor Company, which actually the same with General Motors having a PEG ratio below 1. I just choose Ford Motor because of affordability reason and I love the company for personal reasons. General Electric Company, LG Display Company Limited. We also have Datto Holding Corporation's a tech stock. ArcelorMittal or ticker MT, which is a steel company. One of my favorite companies, which I already have a series of video, Consumer Finance and Service Company, Rocket Companies Incorporated, and I also have Sbux Corporation, which is being owned by Pershing Square. One of the owners of the stocks is Pershing Square of Bill Ackman. By the way, ASO is being owned by Tiger Global Management LLC. So if you had both actually ASO on my IPO video for this company, you actually have earned more than 100% return at this time. RTT is also owned by an Age Capital Management, Baron Capital Management, one of the Garp investors according to the IKR terminal, while CLDR is owned by Capital Research Global Investors and Holosen Advisors LP. First, let us sort them by PEG ratio. So let us do it from smallest to largest. So MT is the number 1, followed by Dana, while number 8 is Sbux. Then after that, having put all PEG ratio, and then we'll go to our first elimination method, which is price to earnings ratio. So our PE ratio, which we will compare that to S&P 500, which it has 33.51 according to Bloomberg.com for the as of the closing of April 12, 2021, in which it has a PE ratio of 33.5, price to book ratio of 4.51, and price to sales ratio of 3.09. So guys, elimination is we have to exclude those companies having very high valuation compared to S&P 500 or its industry sector. So why we're going to choose S&P right now? Because we have a lot of companies in different industries. So better to choose S&P 500. So first elimination in PE, let's see which company we are going to eliminate. So we have to go to up this PE, then smallest to largest, then having a huge valuation compared to PE is Datto Holding Corporation. So therefore, we're going to eliminate Datto Holding Corporation. So we have to mark it red, or you can delete it. Okay. Now, after that, we were going to go to price per book value or P over B multiple. And then we have to sort it out again to rank them to see which one has a higher valuation compared to its price per book. Just move it upward, then smallest to largest. Then we got the unreasonable or the very least price per book value is Starbucks having negative 16.84. So therefore, we have to eliminate this company. So therefore, we already have 8 left. So why I remain RKT, or why I have to choose, I choose not to eliminate RKT because 5.35 compared to 4.51, for me, that's still reasonable range, not too high valuation. Then next, we're going to compare these companies to S&P 500 price to sales ratio, which is 3.09. So as you can see, Cloudera has 4.22. The runaway winner in price to sales ratio is, again, ArcelorMittal or MT. Now, the one here that does not meet my criteria is LPL, having no price to sales ratio because it has a negative APS. So we have to eliminate that company. So right now, we have 7 companies to decide which one is good for long-term investing. So in this regard, we are going further to its fundamentals, choosing the number 1 stock, which is ideal for long-term investing, as I said earlier. Current ratio, the ability of the company to pay its short-term obligations or current liabilities as it came due. RKT is number 1, having 2.92, while Dana comes second and Ford come last. Meanwhile, per growth, of course, we have GE at 323%, which is amazing, followed by MT at 272%. Then third is Dana Incorporated. It's also necessary that we're going to look at their quick asset ratio because this is the ability of the company also to settle their current obligations using their quick assets that is easily disposable or can be translated into cash. So in layman's term, it must be you have to exclude inventory in the equation. So you only include cash and cash equivalents, short-term investments, also accounts receivable. So with that, the winner is Cloudera having 1.38, followed by GE at 1.22, while Rocket at 0.39. The least is 0.34, which is Academy Sports and Outdoors. You just have to remember that the ideal is 1:1. So therefore, MT and ASO is lagging behind with regards to liquidity positions. So let's go now to debt to equity ratio, in which it must be the lower the better. The ideal must be 2:1. So RKT having 0.79. So for me, that's the best company to invest to because it has at least no debt. When you see on its balance sheet, it has a huge debt. But look at their equity. It has also a huge equity. Okay? So actually here, Ford is not good for investing because it has a huge debt. In fact, their debt equity ratio is 7.67. Going into profitability. So profitability is very important because you have to look at which company is good for investing. So you have to invest for a company that earns money, of course. So if they don't earn money, if they don't have a very good margin that can support the operating expenses, how can they survive long term, isn't it? Rocket companies has 86.10% of gross margin. So looking at the financial statement of Rocket companies or looking to the investment board such as Yahoo Finance, you can find their gross profit margin or even in the TIKR terminal. So you have to crunch its data according to your interpretations with the financial statement. So like what I did, I have to crunch their their income statement. So I have to get their gross revenue and I have to find out the service cost related to their revenue. So that's why I got 86% of gross profit margin. So you have to make an additional effort with regards to your investing, because remember guys, it's your money and your money is precious because you work hard for that. Then next to the Rocket, the one having a huge gross margin is Cloudera Incorporated, having 78.2%, which actually reasonable or fair enough to a tech company, having also a SaaS platform or subscription as a service company. Followed by a brick and mortar company, which is ASO Academy Sports and Outdoors Incorporated at 30.5%, while the last is Ford, having 4.8% of gross margins. You also have to look at net income margin. So Rocket actually has 51.43%. So that's why I'm always saying that Rocket is a best company, is one the company that is best to invest because of their fundamentals. Yes, they're lagging behind with their valuations, as you can see, but their fundamentals with regards to liquidity, solvency, and profitability, Rocket is at front. Meanwhile, return in equity, Rocket has 164.9%, while lagging behind is Cloudera having negative 12.7%. Come next to Rocket is ASO having 29.4%. And then GE actually, which is for me a good value play currently because of its price and its fundamentals and its growth, having 16.9% return on equity. Next step is we have to compare their stock performance. So let us compare it to S&P 500 one-year return, which is 50.45%. Of course, the higher, the better. So Dana Incorporated has 203.10% increase. Meanwhile, it is followed by Ford having 165.6% and ASO 123.6%, which comes at number 4, while MT is 155%. RTT lagged behind having 4.9%, being one of the most volatile stock that we have saw. So Reddit had connived or had shown interest this last month or the past weeks. So it went to 41 and the stock go back again to $22. So right now I have more than 200 shares of this stock. I also calculated their intrinsic value. So RTT intrinsic value, which is this one guys is subjective. So RTT has 92.06, while Dana has 153.19, while ASO is 93.27, while GE is 1,131, while Cloudera is poor at 41.39 and Ford at 22.12. Factors for considering our stock to buy is comparing or knowing their potential gain as to intrinsic value and then to the mean analyst target, which is typically 12 months. Okay, so RKT has, according to my intrinsic value, which again, a subjective one, is having a 315.25% potential return compared to 92.06 intrinsic value, while Dana has 474.80% with intrinsic value of 153.19 compared to the latest closing price as of April 12, 2021 of $26.65. Meanwhile, you have the potential to be an it-bagger for GE if you're going to hold the stock long term, or we don't know when, until when the GE can have that share price appreciation, because according to their growth, they have that capacity to have at least $1,131.64, followed by MT, ArcelorMittal, having 3,463% of potential gain compared to its intrinsic value. That is, it may have a 1,031 stock price in 5 years from now. And then, from mean analyst target, the front runner is Cloudera, having 27.42%, while Rocket is 11.37, a third, and MT is 14.58%. But we all know that if these growth stocks would have a return higher than S&P 500, or they will beat the analyst estimates, probably this analyst would give them an upgrade higher than the current price that these stocks are having right now. Economic moat. So RKT has a narrow economic moat. So it means that it has a slight competitive advantage over its peer. And I believe on that because RKT has this technology also just like having a data lake of their all companies that they a one-stop shop for consumer finance. So if analysts will finally consider them or recognize them as a tech company, then that $92 valuation is easy because normally tech valuation is around $80 or $75. Also, GE has a narrow economic moat while the rest has none. So we all boil down which stock is the best stock to buy if you have $1,000 to $2,000 if you're going to hold it long term, or has the potential to give you profit at the short term. So now at number 1 is MT, ArcelorMittal, which actually has a rank of 3.19. Followed by DAN and GE. Actually, Dana is a very good one because it is an automotive OEM. Followed by Rocket at number 3. ASO at number 4, Cloudera at number 5, and Ford, which to least is ranked at number 6. That said, guys, what makes ArcelorMittal as well a best stock to buy right now is their plan to having an annual dividend which will be increased over time. After paying that base dividend, they also have planned that the 50% of the surplus free cash flow will be allocated to a share buyback program to be completed over the subsequent 12-month period. So they have this dividend plan, they have this buyback. So good luck to shorts, right? And also share buyback program can cause the stock to increase because of surprising the supply at the market. By the way, guys, I'm using Cldr terminal on my research with regards to its fundamentals, to its news, the overview, and I also track the gurus as I discussed earlier, like that Garp investing. So you can use the Cldr terminal for free. Just click that link that I have in the description below. That's all for now, guys. So if you like this video, then click that like button and that subscribe button if you're new to this channel. Also, don't forget that notification bell so you'll be keep updated on my upcoming videos. Don't forget to leave a comment for any stocks or any suggestions or comments in this video that I have on this one.
We'll be right back.